to this session of our course on Financial Institutions and Market. I am Dr. Sonam Bhadoria, Assistant Professor at Swami Rama Himalayan University. In today's lecture, we will explore a fascinating area of the capital markets that often gets overlooked but plays a vital role in corporate financing and investment strategies, warrants and convertible instruments. These instruments are particularly interesting because they fall into a special category known as hybrid instruments, blending features of both debt and equity. For companies, they offer flexibility in structuring their capital needs. For investors, they offer a chance to participate in equity-like gains with a different risk-reward profile. Let's start by understanding what warrants are. A warrant is a financial instrument that gives the holder the right but not the obligation to buy a specific number of equity shares of a company as a predetermined price within a specified time period. Think of it like a long-term option. If the share price of the company rises above the warrant's exercise price, the warrant holder can buy the shares at a discount and potentially earn a profit. If the share price does not rise above the exercise prices, the warrant may expire worthless. Warrants are typically issued by the company itself, unlike stock options, which are usually created by the stock exchanges. They are often attached as a sweetener to other instruments like bonds or preferred shares, making those securities more attractive to investors. Here is a simple example. Suppose a company issues a warrant, allowing the holder to buy one equity share at Rs 100 within the next 3 years. If the market price rises to Rs 150 in 2 years, the holder can exercise the warrant, buy at Rs 100 and either keep the share or sell it at Rs 150, making a profit of Rs 50 per share. If the market price remains below Rs 100, the warrant might go unused. Now let's talk about the convertible instruments. Convertible instruments are financial securities such as convertible bonds or convertible preference shares. They can be converted into equity shares of the issuing company either at the option of investor or automatically under certain conditions. These instruments begin their life as debt or preference capital and later become equity capital through the conversion process. This gives them a hybrid nature, offering fixed income initially and equity ownership later. There are two primary types of convertibles. First is convertible debentures. As we discussed before, these are the debentures that can be converted into equity share after a specified period or at a discretion of the holder. Until conversion, they function like any other debt instrument, providing fixed interest income and repayment of the principal. Convertible preference shares, these carry a fixed dividend and may be converted into equity shares after a certain period. This allows investors to participate in equity gains while enjoying the safety and fixed income of preference shares initially. So, what is the motivation for companies to issue warrants and these type of convertible instruments? We can discuss like what are the basic advantages of these type of instruments. The first one is the lower cost of capital. Since investors are given an additional conversion feature, companies can offer lower interest or dividend rates compared to traditional debt or preference shares. Deferred dilution. Conversion leads to issuance of equity shares but only in the future. This means companies can delay equity dilution until they are more profitable. Increased appeal to investors. Warrants and convertible instruments are attractive because they are fixed returns with potential for capital appreciation. Cash flow benefits. Warrants bring in capital only upon exercise. Convertible instruments can delay or avoid large immediate outflows for repayments. Now, explore the advantages for investors. From the investor's point of view, convertible instruments offer a blend of stability and growth. Initially, they receive fixed interest or dividend income, which appeals to conservative investors. Later, if the company performs well, they can benefit from equity appreciation by converting the instrument into shares. Warrants, while riskier, offer high upside potential with relatively low upfront investment. Investors pay a small premium for the warrant, and if the share price rises significantly, the returns can be substantial. However, both the instruments also come with different type of risk. If the share price does not rise above the warrant's exercise price, the warrant becomes worth less and there will be no any income for the investors. Then, if a company underperforms, convertible instrument holders may not benefit from the conversion and the returns may be limited to what they had get from a standard bond or preference share. Also, there is credit risk. The credit risk of the issuer matters. If the issuing company faces financial trouble, investors may lose both their fixed return as well as the conversion value. Those are the few risks associated with this type of instruments. Let me share a practical scenario to illustrate the use of these instruments. Suppose a startup issues 5-year convertible debentures with 6% interest rate and a conversion option into equity or shares after 3 years at rupees 120 per share. If the company becomes successful and its share prices rises to rupees 180, the investor can convert and make a capital gain. If the share price stays flat or drops, the investor can simply keep earning 6% interest and redeem the debentures at maturity. This dual benefit, downside protection with upside participation, is what makes convertible appealing. Let's now look at the regulatory framework in India related to these type of instruments. The issuance of warrants and convertible instruments is governed by the Companies Act 2013 along with the SEBI regulations. For listed companies, SEBI has laid down clear guidelines on pricing, conversion and disclosure requirements. Warrants are often issued under preferential allotments to promoters or strategic investors and are subject to a lock-in period. Convertible securities issued through public offers or private placements may require credit rating, trustee appointments and specific investor disclosures. Now, let's take a moment to discuss between the difference of warrants and convertible instruments. The key difference is that warrants do not offer fixed returns. They are essentially a right to purchase equity in the future. Their value depends entirely on share prices performance. Convertible instruments, on the other hand, do offer fixed returns such as interest or dividends until conversion. They are initially treated as debt or preference capital and only later they become equity. Also, from the company's point of view, convertible instruments create immediate liabilities in the form of interest or dividend obligations. Warrants do not carry such obligations unless exercised. So, to summarize today's session, see, warrants give the right to purchase equity shares at a future date and price. They are speculative instruments with high return potential. Convertible instruments begin as debt or preference capital and offer the option to convert into equity. combining safety with growth. These instruments are flexible tools for companies to raise capital and for investors to balance income with capital gains. However, investors must assess the issuing company's fundamentals, conversion terms and market conditions before investing in these type of instruments. As we conclude the session, here are few reflection points for you to think about, like when should a company use convertible instruments instead of traditional debt or equity? Think, how can investors evaluate the value of a warrant or conversion option? Also think, what are the key risks to watch out for in hybrid instruments? Thank you for joining me in this session on warrants and convertible instruments. In our next lecture, we will compare equity, debt and hybrid instruments to understand how they differ in terms of structure, risk, return and suitability. Until then, stay informed, stay curious and continue learning. Thank you. Namaste.